China is a big topic and we can go in many directions here. I work at Russell Investments and I'm responsible for managing all our equity funds investing in, China. We have a dedicated China fund that I manage and also broader emerging markets funds. So in this session, I will cover what we believe is the attraction of China and why asset owners and allocators should consider a dedicated allocation to China, including some of the diversification benefits you can get from investing in this market. And we will also talk about some of the more unique characteristics and dynamics of the market and how we think is the best way to approach it and invest in it. I only have a few slides to share with you, but it will be mostly conversation and hopefully followed by some questions afterwards. So why should you invest in China in the first place? Well, it's by far the largest component in the EM investment universe, emerging markets investment universe. China, as you know, is already an important engine of global growth. It's the second largest economy in the world. And it is estimated to surpass US by the end of this decade. So it's simply become too big to ignore. Chinese capital markets may have faced recent headwinds, lagging the index if you follow the news and follow the index returns. But this doesn't stand in the way for the long-term investment case. That remains intact. And the key here is how China continues to shift from a low-cost manufacturing-led economy to one that is consumer-focused and tech-led, and creating some very interesting long-term structural growth themes for asset owners to be exposed to. So you can invest in Chinese companies listed what we say offshore and onshore. The onshore names commonly referred to as China A shares. They're listed in Shanghai and Shenzhen exchanges. And offshore listings are predominantly, then we talk about Hong Kong and US listings as ADRs. And the combined onshore and offshore market for China is among the largest and most liquid in the world. So it provides a very exciting opportunity set for skilled stock pickers. And thanks for putting the slide too. This is showing basically the breakdown of the total Chinese opportunity set into the onshore market and the offshore market. And you can see here, just from that simple table with the sector allocations, how it's very different composition. I think the onshore market is increasingly become key for investors to access in order to be able to tap into the real drivers of China's growth in the future. So the composition of this market is very different from the offshore. Offshore listed stocks offers it's more constrained exposure to sectors. So it also suffers from very high concentration in very large names. You can see communication services here and consumer discretionary being the two largest sectors. And those sectors are dominated by three names: Tencent, Alibaba, and Meituan Dianping, all in the more social media platform, internet, e-commerce kind of space. And that accounts for a third of this index. So it is quite top heavy, dominated by these companies. You can see from the bar chart as well, the number of companies that you have access to in the onshore market is, multiples of the offshore list. So it's a much deeper market. It's really less efficient too. And you have a lot of the innovative sectors in there, such as healthcare and technology and fintech, as well as consumer discretionary and consumer staples. And they provide a more direct access to these attractive structural themes that I talked about, benefiting from, the domestic disposable income growth as the middle class is rising, growing, and that shift to the more consumer and service-oriented economy away from cheap manufacturing. And that whole innovation and high-value tech segments and healthcare is one of the priorities of the central government. So there are some really strong tailwinds to these themes as well. China is well represented in the index. It's just below 37% index weight at the moment. It went as high as 40 last year, but it's very dominated by offshore listings. The onshore listing right now account for only around 5%, and this has been a very recent development. And a few years ago, they were not part of global indices at all. So even if they are included, they are significantly underrepresented. MSCI, that 5%, that is due to MSCI having a 20% inclusion rate on the onshore market. And that's grew from 5% initially. So you can expect that to continue to grow in the coming years. And how long until we get to the full inclusion is a question we often get asked, and it's really hard to say. It really depends on capital market reform efforts, but I think it's not a question of if, but rather when. And our advice to our clients is to get ready for this and not wait for benchmark changes, to think about having a strategic allocation to China.